Hello and welcome to the Fund Your Retirement Podcast, a guest-led podcast aimed at sharing insights and strategies that help you build long-term wealth. Today I'm delighted to introduce Bruce Packard. Bruce is an ex-city analyst turned private investor who writes regularly for SharePad, Money Week and his blog site brucepackard.com. Bruce talks about the advantages amateur investors have over professionals and how he believes amateurs can outperform most professional fund managers. He talks about his top 5 holdings, his latest high conviction positions, his biggest investing mistakes, and of course much more. If you like this type of content, then please subscribe and I hope you enjoyed the episode. Bruce, thank you very much for joining us today. Really happy to have you on the show. The way I like to get all the guests to start, Bruce, is I like them to share their investing journey, how they got started. So what was the catalyst or the combination of events that got you started on your investing journey?
Well, the first share I bought was Adnams, which is a brewery in Suffolk. The reason I bought it was when I was 18 years old, I'd heard that the AGM was a bit of a social occasion.
Oh, right, nice.
It rather annoyed the company that people were going, all these Suffolk farmers were going along just to meet up and enjoy the lunchtime spread. And I did actually go to the AGM with my father, but the irony is that it turned out to be a 10-bagger as well.
That was a nice first taste.
Yes.
Beer included.
Yes. And Adnams have been around for over 100 years, been a brewery on the site since, I think, before the Black Death. It also showed me that you don't actually have to take lots of risk or invest in technology that's unproven in order to get very high returns. And I should say also it was a 10-bagger over the course of a decade rather than it shooting up overnight. Yeah, just a decent business with a high return on capital back then. You learn more from your failures than from your successes, but it did open my eyes to this idea. There's no relationship between risk and return, that you can make high returns with relatively low risk. And also buying and holding is an easier way to make money than trading in and out of stocks.
Yeah. From that, you transitioned into becoming an equity analyst.
So that was when I was 18, but I went to university, I studied theology, and then, as you do, got a job as a management consultant. In about 2000, the investment banks were just pulling people off the street who knew how to use Excel and PowerPoint. I don't think I'd get a job in Credit Suisse now with a degree in theology and a couple of years of PowerPoint and Excel experience under my belt. But It was just at that time when there were a lot of senior people who knew a lot of stuff but weren't particularly good at using computers. And there were a lot of young people who were keen and to work hard, who didn't know much about investing, but did know how to use the Microsoft products.
That was your entrance into the equity world then. And it was primarily banks that you focused on.
I did banks for about 13 years and I actually met up in West London with a friend of mine who also did banks and quit about 10 years ago as well. And we just shared a pint and laughed about the fact that, aren't we glad that we're not still writing about Lloyds and Barclays and HSBC and Standard Chartered, and the share prices of, if anything, they've gone backwards over the last decade. He's a bit older than me and he worked in corporate finance, but he said in the 1980s, it was a lot of fun, but it wasn't much money. And then a lot of money came in and they took away the fun. And now they've taken away the fun and they've also taken away the money.
With you working on the institutional side of things as an equity analyst, you get to see both sides of the coin, both as a private investor and working alongside the fund managers and in the professional environment. And I know that you've come to a bit of a conclusion that amateurs can do just as well as professionals, if not better. Would you mind sharing a little bit about that with the audience?
I feel like in most walks of life, professionals have an advantage. So I wouldn't like to open the batting against Jofra Archer. I'm not saying that amateurs are always at an advantage, but I think in investing, they definitely do enjoy some advantages in terms of liquidity. You can focus on the smaller illiquid stocks. I would suggest Best of the Best is an example of something that's very liquid. It hasn't done particularly well in the last 18 months, but it's done very well over the last 10 years. And most institutions wouldn't look at that because even if it doubles, trebles, quadruples, it's still going to be a very small part of their portfolio. Whereas an amateur can look at that and say, actually, I can take a sizable position in something that's got operational gearing that if it does well. So that's one aspect of it. There are actually certain rules that the professionals have to adhere to so that they can't have too concentrated a portfolio. They're the UKIP rules, which are 5, 10, 40, which stipulates that no more than 10% of the fund can be invested in a single security. Positions in excess of 5% must collectively sum to no more than 40%. So that just prevents a fund manager, say, having a 50% position in one stock. And that obviously reduces risk, but it also potentially reduces your return as well.
As a private investor, you have the advantage of really backing your conviction.
Yeah, absolutely. And I also think some of the things that the professionals market as an advantage, like meeting company management and corporate access, aren't the advantage that they claim it is. So for a start, if you're meeting company management, if you're not the first or the second person to meet them, and the company management are giving some sort of steer that things are very positive or things are very negative, if you're the 15th institution to meet these guys, you're not actually getting any new information because they've already had 14 other meetings. The other thing is that having been a sell-side analyst, I've sat across from these meetings on the side of the company. I've taken companies to see the French investors or the Swiss investors. And actually, a lot of the fund managers don't do the work themselves. They ask the brokers for the questions. So it's slightly embarrassing because you sit there and you've printed out a whole page of questions for them to ask the company. It's in the same font and it's pretty obvious they've all printed out. You go from meeting to meeting and they all have the same piece of paper, which is your questions to ask. And I just feel like, yes, if you're going to do the work and sit in front of it and ask company management questions about stuff that doesn't quite make sense, but if you're just going to go through the motions, then that's not actually much of an advantage. And as a specific example of that, in 2006, I took Lloyd's to see some French investors. And at the time, this was a bit of the bad debt portfolio in the unsecured book was very bad and bad debts were rising quite fast. And this was actually a bit of a canary in the coal mine for what happened later in 2007 and 2008. But what Lloyd's was saying is, 90% of our loans, of our personal loans, and 75% of our credit card lending is to customers who we already have a current account relationship with. And that means, by implication, our bad debts are going to be better than other people. I was sitting opposite these investors, these fund managers, who were dutifully writing down these numbers. The only problem was that they failed to check that there was no difference in Lloyd's bad debts with Barclays' bad debts or with anyone else's bad debts. The bad debts were still trebling out of control. So it's a nice soundbite, but you have to then go back and cross-check the story with the numbers that are being reported. That was just one example that I felt these fund managers, they tout the fact that they meet management and they get some sort of more information than amateur investors do. But I don't think it's really true. And if it was true, the regulator would have quite a close look at things. From that standpoint, I definitely don't think that the amateurs are at a disadvantage anyway.
We're living a sea of information as well. The abundance of information now would you say that it's leveled the playing field a little?
Yeah, absolutely. I think things like SharePad and Stockopedia, they've really helped people because the data was always out there, but it wasn't in a particularly easy to digest form. You could always get hold of annual reports, but now you've got these databases. It really creates an advantage for the amateur investors versus the professional investors. They've always had Bloomberg, but these new databases that have been around for 10 years now, those are really leveling the playing fields for people as well, I would say.
Yeah, I guess it's worth pointing out as well that you can back your conviction, which is obviously good when it's right, but when it's wrong, it could have the opposite effect. So
yeah, absolutely. That I don't think any of these databases would claim that they get things 100% right, but what they do is they help you make better informed decisions with data. And if you are going to go into something that's highly speculative, people now tend to know that what's highly speculative, and they can also identify high return companies with a good track record. Those tend to be flagged on all these systems, with whether it's SharePad or Stockopedia. You can see that the quality companies are easier to identify.
Well, when we talk about leveling the playing field, you've mentioned in the pre-podcast chat that you're looking into Chat GBT as a research tool. Is there anything you can share with that, or is that still an ongoing project?
So that's an ongoing project, and that was really, that was a sort of project to teach myself some of these methods, just what is AI good at and what it's bad at. And to be honest, I haven't gone into the deep learning stuff, that's the Chat GPT stuff, but I messed around a little bit with algorithms like naive Bayes and decision trees and random forests. And what I tended to find is that I was analyzing language, the financial language, and what I tend to find is what worked quite well is looking for the contradictions between the language and the reported numbers.
The language in the annual reports?
Yeah.
Okay.
Yeah, so a lot of companies, and the most obvious one is HBOS in 2008, says, we have a strong balance sheet. And you look at the balance sheet and you go, if that's their definition of a strong balance sheet, either they don't know what a strong balance sheet is, or they think that they can just say anything that they like and people will lap it up. And a lot of companies do this, that they will say, oh, we have a strong balance sheet. And if you go and check the numbers, that they've got negative tangible equity, debt's too high. Another one is we are highly cash generative. And then you look at the cash flow statement and it's nonsense. Of course, they're not cash generative. And Hike would be HEIQ would be an example of that. Last year, they were claiming to be cash generative, and that's fallen in value 90% because actually they weren't cash generative. And so that I feel like that's an interesting little trick that you can actually do that with your eyes. But that came out of the analysis that I was doing, looking at language and comparing it with the performance and trying to figure out what was going on. And it's something I'll return to. I think it's a fascinating area. I feel like everyone's got access to the same financial numbers, but there are clues in the outlook statements that there's a real knack to reading the outlook statements. It tends to be very bullish and then however. And if you read the sentence after the however or but, or then you tend to get, oh, okay, things aren't going quite as well as the management would like to pretend. And the other, just related to that, is the other thing is that companies that tend to talk about the challenges and then how they're addressing the challenges and what they're going to do about them tend to do well. And companies that tend to say, everything's wonderful, no clouds on the horizon, often they're so bullish because they might need to come back to the market to raise more money. So that there is something in terms of the company managements that communicate more honestly with investors actually tend to do better over the following 5 years.
So over the years, then that's probably a skill that you've developed, reading so many annual reports, that you're able to see these little nuances within what.
Yeah, I think that the interpretation of the numbers is actually fairly straightforward, and it's helped by things like SharePad. Reading the outlook statements, there's a real knack to it, and it just takes time to develop that knack. But I don't think it's intelligence. I think it's just getting used to the way management communicate. Maybe there's a role for technology there as well to help you read in between the lines.
How would you best describe your investing style and strategy then, with all them decades of experience of being in the industry?
Yeah, low frequency, buy and hold. Partly that's because I don't like paying capital gains tax and I like to just hold on to things. But also there's something very satisfying about owning a share that's gone up in value a long way. The most frustrating thing is a couple of things. If you sell too early, which is something I've done with Keyword Studio. And the other thing is you look at these things that have gone up very well and done very well, and you think, oh, why didn't I buy 10 times more of that?
Yeah. One of your articles, you do describe that at one point you had 5 stocks that represented 75% of your portfolio.
I've gone back and checked that, and Games Workshop and Impacts haven't done so well over the last 12 months. So that's now down to about 2/3. So 66% is my top 5 holdings.
How many stocks do you have in your portfolio then?
It's just over 20 at the moment. And those 5, just off the top of my head, I think Games Workshop, Impacts, Bank of Georgia, SDI. And actually, a lot of these are slightly a mistake because they started out as quite small positions, but they did so well, they became very large positions.
Yeah, I was going to ask that question.
The Bank of Georgia started out as a large position, and it's still a large position. But the other ones, Games Workshop was a mid-sized position, but the other ones, Sylvania Platinum. But really, my mistakes were SDI and Impacts, which I knew these companies quite well, and I should have bought more of them, and I didn't. But they've gone on to do fantastically well. So they're now quite a large part of my portfolio.
Bank of Georgia, that's an interesting one. How did that come to be?
Yeah, so that came about because I was working at Seymour Pierce, which is a broker that has now, I think, who was it bought by? Cantor Fitzgerald. But so Seymour Pierce no longer exists. But after the financial crisis, I was working at Seymour Pierce, and I got this email that was almost, it wasn't quite, but it was almost like one of those things you get from a Nigerian bank saying, we've got 17 million. Like to, dear sir, I'm the chief executive of the largest bank in Georgia.
Yeah. Please send me some money.
I have a GDR and I'd like to list on the London Stock Exchange. Can you help? And he sent this to all the UK banks analysts, of which there were probably about 30, who 29 of them hit delete. And I thought, oh, this is quite interesting. I know the country reasonably well. And it was a bank reporting 20% return on equity, growing at about 20% a year. And it just seemed, and it was trading on 5 times earnings as well. And I thought, this is a bank that actually has quite an attractive investment case versus the other UK banks, which are going backwards and still going backwards to a certain extent now. Yeah. Wrote the 40-page note. We listed them on the London Stock Exchange. We took them around to see hedge funds. And it was very interesting, the feedback, because the feedback was, this is a great investment, but it's very illiquid. And as an institution, I can't get in or out of it very quickly. And Also, Sberbank is trading on 5 times earnings as well, and I might as well just buy Sberbank, which also has a very high market share in Russia. As it happens, I feel like that was a terrible piece of analysis, because Bank of Georgia, at least Georgia is a democracy, and Sberbank is Russia, and you're just not sure what investing in a country like Russia. The warning signs were there from a long time before. But it was interesting because I took this round to the institutions, and the reason for not investing was the lack of liquidity. It wasn't to do with the valuation. It wasn't to do with the country risk. And so I said, okay, I've taken this round to a lot of people. A few people have taken a position, but I went to the legal and compliance department at Seymour Pierce and said, well, I want to buy some. And they said, we really don't want you to do that because that's a conflict of interest. But what are you talking about? I've written a 40-page note saying buy this share. Now that I struggle to find institutional interest, I feel like actually I want to buy the share. And they said, we can't stop you, but we don't really want you to do this. And I said, show me the rule that says I can't do this. And they said, well, if you do this, you're not allowed to sell because it's a corporate stock and you have to have a buy recommendation on it. I was like, okay, that's fine. I'm happy that this is going to be a long-term hold. I bought quite a lot of Bank of Georgia, which is, if you look at the chart, it hasn't done particularly well, but it's also demerged Georgia Capital out of the business. So you have to add the market cap of Georgia Capital to Bank of Georgia. And on that basis, I think it's up 4 or 5 times since the London listed.
So the 66% is primarily then because they've done so well over the years that since you've been invested in them then? How long on average have you held those stocks, would you say then?
Georgia 10 years, SDI, I think more than 5 years, Sylvania, again, more than 5, Impacts, again, more than 5 years. So everything that's a large part of my portfolio, it's because I've held it a long time and it's gone up a lot.
So do you have a couple of companies that you're looking at just now that you have a high conviction in, or that you've just recently bought perhaps, and your reasons why?
Yeah, I'd say high conviction, I have a high conviction that the current share price is wrong. Now, what that means is that if things go well, it's far too cheap. And if things go badly, it could be a disaster. So I think it's very hard to identify things that are a high conviction that you absolutely know are going to go right, that are going to be a 10-bagger. But it's relatively easy to identify shares with a bit of operational gearing, with if a bit of revenue growth comes back, then that drops through to the bottom line. And I put both Superdry and Frontier in those categories. Superdry is not without risk, but my feeling is that the brand, Jules Duncan does understand branding. And I feel also the brand has become so uncool that it's almost become cool again in a semi-ironic way. As an example, I was skiing last week, and one of the Berlin DJs who was there was wearing a Day-Glow pink 80s fluorescent ski suit and a little sparkly Superdry bum bag.
Very retro.
Very retro, very ironically cool, semi-ironically cool. And I feel like Superdry, it was a cool brand 15 years ago, and it's now become so unfashionable that maybe it's become cool again.
Yeah, and what was the other company there, sorry?
The one is Frontier Developments, which is David Brabham originally came up with this game for the BBC Micro called Elite. And then in the 90s, he created this company, Frontier Developments. The computer games are hard because it's very much, you can have a hit, can you repeat the formula? It's a bit like the film industry. No one quite knows what makes a successful computer game. They've had a bit of a run of bad luck. They've had Elite Odyssey, wasn't particularly well received. Formula One Manager was actually well received by the critics, but hasn't done particularly well over this Christmas. The revenue's going backwards at the moment. And I actually quite like investing in profitable companies where the revenue's going backwards, because I'd rather invest in a profitable company with low growth or falling revenue, and the numbers look pretty bad in that particular year. But if they can generate revenue again, then the earnings tend to fall through to the bottom line. I tend to avoid companies that are fast growing but that are struggling for profitability, because there always seems to be a story. Occasionally the growth can convert into profitability, but a lot of the time the growth can't, and they carry on just issuing shares and funding, coming back to the market for funding. So that tends to be a little bit of a rule of thumb for me, is I'd rather invest in a company with falling revenue that's net cash and can get through the downturn and turn things around.
Are you primarily a small cap investor?
Yeah, I avoid large cap because I find them a bit boring. They're harder to understand. I know banks very well. Actually, they haven't been great investments. So in some ways, being an equity analyst in banks and not being allowed to buy my own sector has been a helpful thing, because Actually, I've avoided this.
It's kept you out of it.
Yeah, it's been at some stage, all value investors have bought one bank or another bank, and generally it hasn't worked out particularly well.
So we've covered quite a bit on the buy side there and some stocks that you've been looking at recently and some of your bigger holdings. Perhaps maybe what is equally as challenging is also knowing when to sell, which you've mentioned earlier on that you sold Keyword Studios too early. What can you learn from that? What can you share from that? And so that A, that you don't do that again, but B, so the audience can get an insight.
Yeah, so it quadrupled, and I sold it because I wasn't sure about the acquisition-led growth, that they were buying a lot of companies. I can't remember how many it is, but most of their balance sheet is now goodwill. They've bought these companies all over the world, and I just thought I could see this going wrong and falling apart at some stage. But actually it hasn't, and they've done really well. They're all credit to management, and they seem to be a very good company. But generally from that, I thought it's better to hold on even until something goes wrong. I feel like that's the catalyst. You want to own things until the story changes. And one company I did sell, I did top slice a bit, was Impacts, but just because a year and a half ago, I felt the valuation got too demanding. Yeah. And there's an interesting thing with fund managers that they tend to get to about 30 billion assets under management. And then they become harder to manage, because when you've got that amount of money, it's harder to deploy it. And that's not true of all fund managers, because obviously BlackRock is huge. BlackRock are 10, 20 trillion. 30 times that size. Yeah, they're in trillions. And so they've institutionalized the process. So that there's an interesting debate to be had about impacts, about, is it the process? Is it the systems that management have put in place? Or is it a couple of star fund managers? And I feel like actually Impacts, it could have the potential to go on and become twice, 3 times, 4 times bigger. But it's a risk, because a lot of fund managers, a lot of hedge funds get to 20, 30 billion under management, and then they struggle, and the assets under management go down and performance suffers.
And I guess your experience working on the analyst side with the fund manager, you've probably seen that from time to time. You mentioned there you do top slice as well. So do you use stop losses or anything like that?
Don't use stop losses. In fact, I tend to average down, but I think if you're going to average down, it's important to have a plan beforehand. You don't buy something, it falls in value, and you go, oh, I'm really annoyed, I'm going to buy some more, because if it was cheap at £4, I'd like it even more at £3. It's very interesting psychologically. Quite often you take a small position and you either become more comfortable with the investment case, or you start thinking about all the reasons why you might be wrong. And so far, averaging down has worked pretty well for me. I bought some Legal and General in March 2009, and that halved, and I bought some more just because I felt the reason for the sell-off was not right, that an insurance company like Legal and General shouldn't be suffering a liquidity problem in 2009. Sylvania, I averaged down into. Superdry, I guess I've averaged. If I haven't averaged down in Superdry, I've certainly haven't averaged up. It might be at the same level I bought a couple of months ago. Frontier Development, I have averaged down, but that was also, I looked at the chart and thought, that chart looks horrible. But at some point, I think they're going to be able to turn things around. So I tend to look at charts and that looks horrible. So that's going to prevent me taking a big position, trying to call the bottom. But I do look at the chart and think I'm going to take a starter position, and fully expecting that you're never going to call the bottom. So you're either going to buy back on the way up, or you're going to buy too early. And I'd rather buy too early than too.
In 2021, you finished 24% up, but you mentioned you experienced a 29% drawdown during that period.
Drawdown was 2022. So that was from the peak in 2021, which I think was in September or March, September 2021 to September, October 2022 was the big drawdown.
Yeah. So most people, I'm going to surmise, would struggle to go through that drawdown, but ultimately it ended up paying off quite nicely for you. How did you manage yourself through that? How did you manage your emotions? And
so that I have some very unhelpful advice.
Okay.
If you're worried about a 30% drawdown in equity markets when you can always get out, invest in a private business, and then it turns out that your business partner is an alcoholic. And that will cause you all sorts of stress and sleepless nights, and you've lost money, but also you've lost control of the situation as well. Whereas with equity markets, you're a minority investor, so you don't actually have the control, but you can always get out of the situation. If you're in a private company, you can't. You just, at some point I had to walk away and recognize the loss, but it was a much more painful thing to do because it was a private company.
Yeah. So other experiences have helped you weather that type of experience. And
Yeah, absolutely. And I suppose that's not particularly helpful advice for people who've lost
just
seen
getting
a paper loss
started.
of 30%.
Yeah.
But yeah, there are plenty more stressful things than losing 30% in equity markets.
Also, as well, you've been through the financial crisis. You were investing, I'm going to say, around the .com as well. If you started at 18, you must have witnessed the .com as well in the early 2000s. So you've seen these market crashes. You've seen drawdowns. That experience is going to help carry you through as well, isn't it?
Yeah, I feel like actually in some ways that's what you're getting paid for as an equity investor, is to absorb that kind of volatility, that the sort of investment that sort of grinds away at 7% every year. It doesn't exist. Even if you buy an equity index, you're going to see much more volatility than just a steady 7%. But over the long term, there's a lot of evidence that 7% compound annual growth rate is a reasonable expectation for the stock market.
Yeah, we covered a good portion on the sell side there. As we move to someone who's perhaps maybe looking to get started, build a portfolio, as we've already mentioned, there's so much information available out there. What would you say to someone who's looking to start their own portfolio? Open a SharePad account, and then what? Where do they go from there? How do they start to begin to build a portfolio?
What you tend to find as an investor, if you're a buy and hold investor who holds things for 5 or 10 years, is that say you've got 20 stocks, there'll be 2 or 3 that are multi-baggers, then there'll be 2 or 3 that have probably fallen in value 80% or gone bust. And the majority, the 15 in the middle, have trundled along and not done very much at all, maybe grown at 7% a year or something. And so as an investor, what I'm trying to do is just shift that distribution a little bit so that I have maybe 5 stocks that are multi-baggers and only 1 stock that's been 1 or 2 stocks that have been terrible, down 80%.
So pretty much start off small, do your research, build a broad, diversified portfolio.
I think you don't necessarily have to buy 20 stocks, but also a bit of diversification over time is helpful. So you don't have to put it all into the market right now. You can put some in, wait 6 months, see how you feel.
Is that how you operate with your own stock?
Yeah, so I'm sitting on quite a lot of cash at the moment, not because I particularly think that the market's overvalued or undervalued, more that I get uncomfortable putting lots of money into the market at the same time.
Yeah, so I guess that's helps you then with the averaging down. If the price does fall in a company that you've got a high conviction in, that allows you then to average down and get in at a better price.
Yeah, I've never really read anything about this, but I feel like it's a different source of diversification. People talk about diversification in terms of buying 20 stocks, but actually, if you pound cost average into even an index tracker, you are diversifying over time as well. So that's a way of reducing your risk.
Yeah, brilliant. I mean, it's been really insightful conversation for me, and I hope the audience have enjoyed it. Just as we come to the end and share just one little bit of insight, again, for probably the newer investor, what would you say your biggest investing mistake has been, and what can the audience learn from that?
So it's not actually losing money.
Oh, that's an interesting answer.
Yeah, so I've lost money in a few things. Small position in 4D Pharma, which was supposed to be a human biome thing, and that's been delisted. But I lost a tiny amount of money in that. The biggest amount of money that I've missed out on is only taking a small position in Impacts, or only taking a small position in SDI. And at the time I felt, oh, I've met the manager, these are good stories, the valuation's quite low, feels a little bit uncomfortable buying into a fund manager, things can go wrong, they can see outflows. And actually, with the benefit of hindsight, I've missed out on far too much money. So the position sizing, I feel like that's a real skill, is to invest more money in the things that are going to do well, and invest less money or not invest at all in the things that are going to do badly.
That's a really good insight, and it's not something I think I've heard many come out with. Actually, the position sizing is really for people to come to terms with and get to grips with.
There's an old George Soros quote, which you can interpret in various different ways, but he said it's not about being right or wrong, it's about how much money you make when you're right, and how much money you make when you're wrong. And apparently George was never particularly bothered about losing money or being wrong. He was most angry of himself about being right and then not backing himself, but putting a large amount of money behind his conviction.
Yeah, it's a famous quote there, isn't it? Yeah, Bruce, thank you very much. This has been brilliant. Where can the audience follow you? Where can they connect with you? Where can they learn more from you?
So I write a weekly for SharePad, and also occasionally for Money Week. And I've also had my own blog, which has taken a little bit of a back seat because I'm writing weekly for SharePad.
Yeah, Okay. Do you have any social media accounts? Twitter? Is there a Twitter
Yeah,
handle?
Twitter. I'm on Twitter.
Yep. Okay. I'll make sure that all those links in the show notes below. Thank you very much, Bruce. Really enjoyed it.
Enjoyed it too.